Hey, this is Chase Blackman with the Gulf Coast Home Team, and I'm sitting here with our trusted lender partner, Tim Fitzhugh with the Bank of England, Alabama, and wanted to make a quick video to tell you guys about some of the different loan types that are available and what the qualifications may be for some of those. Tim, why don't you talk to us a little bit about that?
Sure, I'd love to, Chase, and I appreciate it. We kind of have two different segments of loan programs that we can offer. We have a kind of a more traditional and then more of a non-traditional type, product offering. With your traditional loan product offering, you're looking at conventional, like a Fannie Mae, Freddie Mac type mortgage, and along with FHA, VA, USDA as well. And those programs typically, you can get into them for as little as 3% down, or USDA and VA offer 100% financing. And you're really looking at the borrower and their individual needs as far as which program is going to work best for each individual. Conventional is a little more or less forgiving maybe than FHA. FHA was created by the government to help create home ownership in the U.S. So with FHA, you can typically have lower credit scores, lower down payment options, and the ability to use non-traditional credit, non-occupant co-borrowers, and that is all just to help create home ownership. Conventional programs are great. There's no reason to steer away from them, but typically you're going to need a higher credit score to meet their parameters and so forth. We also have non-QM loans that fall outside of kind of your traditional type financing. Those are really good for self-employed borrowers, for investors, and for anybody that just kind of falls outside of the box of where traditional financing would, be able to help someone, whether it's, they just got finished with the, derogatory credit event, whether it was a bankruptcy, a foreclosure, what have you. The non-QM loans can typically provide a better avenue for that individual until, those requirements have been met.
The non-QM loans, are they government-backed loans or?
No, they're not. They're private investor loans. So they all kind of have their different set of guidelines based on the investor themselves.
Okay. With FHA or USDA or even VA, are the rates any higher or lower than conventional?
They can be. It depends on the credit score. So if you have a high credit score FHA borrower and a high credit score conventional borrower, the rates will pretty much mimic each other. But if you have a low credit score FHA borrower and a low credit score conventional borrower, that FHA VA, they'll always have more favorable rates with a lower credit score than what conventional will offer to them.
So talk to me about, we talked about the consumer and, a little bit of the qualifications there. And I want to get into a little more into down payment differences between the two. But let me ask you this. What about the house? Does the house or the house itself or the location of the house have anything to do with any of the different mortgage types?
Yes, absolutely, it can. USDA, for example, you have to be in a USDA eligible area to meet that.
And is that more of a rural area?
Absolutely.
Okay.
Absolutely. So in Baldwin County, we're in pretty good shape with that. But as you move, as we continue to grow, you have less and less, eligible areas left.
So they kind of, create that to incentivize growth in the more rural areas.
Absolutely.
Okay.
That's correct.
What about, the house itself? Does it matter the age of the house, the condition?
The age of the home doesn't matter
Okay.
with any of them. The condition does matter.
Okay.
I mean, you want the home to be safe, sanitary, and sound, and you don't want the borrower, and you do that for a lot of different reasons, but main reason, you don't want the borrower to buy this house and then move in there and then the electricity doesn't work
That's
or
right.
the air conditioned and it's, 100 degrees outside where they won't want to occupy the home.
Right.
So you really want the home to be in good livable condition for them to go in there. Conventional financing is a little less restrictive than the government programs like FHA, VA, and USDA are. They, there's just let a little bit more slide with FHA, VA, USDA. They're going to look for, and they'll do this on conventional too, but you look for any indication that the roof might maybe leaking, if there's water damage on the ceilings, rotten wood inside the house, stuff like that. Of course, that will always need to be, addressed
Right.
and corrected. With FHA, VA, and USDA, peeling exterior paint can be issues. Steps, having the appropriate,
Broken windows.
broken windows. Crawl space is a big thing for FHA now. It has to meet those minimums. So yeah,
And a lot of times, if a house has I've learned if the house has a deck that has any age to it,
right.
typically, they're going to find, a rotten board or whatnot.
That's right.
And know this, that the inspection that the appraiser does is totally different from the home inspection. A home inspection is always advised, and they're going to go a lot more into detail and a lot more in depth than the appraiser inspector is. But if an appraiser who also inspects the home for the USDA or FHA or VA, if they quote unquote flag something for repair, what that means is that they will not loan the money for it until those repairs have been done. If you buy a house and it gets flagged, the seller either has to fix those items before closing and have it re-inspected, or it will not qualify for financing. So down payment, what are the differences in down payment between the loans? A lot of people think that you have to have 20% down to buy a house. Is that a myth, or is that true?
That's 100% a myth. With conventional loans, it's a minimum of 3% down.
Okay.
FHA has their minimum is 3.5% down. However, there are programs that will allow for their down payment assistance programs, which will actually make an FHA 100% or eligible for 100% financing. USDA 100% financing, VA 100% financing. When you start moving over into the non-QM, just kind of outside of the box type financing, those are typically going to require a greater down payment at that point in time, and it's, from a risk, assessment,
Right.
essentially.
Right. You said something a second ago, down payment assistance. We'll get into that on another video, but can you give us a brief, description?
Sure. So I'll use the FHA for example. So an FHA loan is 96.5%, or will allow you to borrow 96.5% of the sales price of the property.
Which is 3.5% down.
Yeah, which is 3.5% down. And then with down payment assistance, you can do a second loan for the remaining 3.5%. So it's a total of 100%.
So is it a second mortgage?
Yes,
Okay.
it's a second mortgage. So you'll have a first mortgage and a second mortgage, but they will total the 100%.
And, staying on down payment, we hear a lot of people talk about PMI. What is PMI?
PMI is any time you put down less than 80% on a.
Put down less than 20%.
Excuse me. Yes, put down less than 20% on your purchase. It's insurance that insures the investor against a loss. The theory is if you put down less money, you have less skin in the game. Therefore, you can increase the risk of loss. So that's what PMI is. It comes in different forms. Conventional has monthly mortgage insurance, single finance mortgage insurance, or split mortgage insurance, which is a combination of single financed and monthly. FHA, they do what's considered upfront mortgage insurance, which is a percentage of the loan amount that's financed back into the loan, and then also monthly mortgage insurance. VA, that is just, it's a guarantee fee is what VA does. And the same thing with USDA. It kind of works like FHA with a kind of the upfront mortgage insurance and then the monthly mortgage insurance.
So let's say somebody puts down a 3.5% down payment. That means they're what, 16.5% less than the 20%. So they're going to have PMI.
That's correct.
Once they get 20% or 80% equity in the house, will it just all of a sudden fall off, or do they have to refinance? What happens then?
It depends on the loan program that they're in. So with a conventional loan, yes, basically what they do is they'll contact their current servicer, say, hey, look, I think we're below this 80% mark. Then they'll get an appraiser out there to verify that. And if it's verified and it's below the 80%, then they're solid. They can have it.
So their payment goes down.
Yeah, so the payment goes down. On FHA, you will need to refinance that to get rid of that mortgage insurance, yes.
What about with USDA and VA?
VA,
there is no PMI.
Well, with VA, they do the upfront where it's financed back in. So it's there no matter what the down. They do a different factor based on your down payment, but it's there. In USDA, typically after you've had a USDA mortgage for so long, USDA will reach out to you and ask you to refinance out of it because it makes the funds available for other people that need it for that 100% financing. So typically they'll want USDA to refinance out of that.
Man, great information. I appreciate you taking some time to sit down and talk with me today and explain these different types of loan options.
Yeah, well, I appreciate the opportunity. Hopefully it helps someone become a homeowner.
Yes, sir. We'll talk soon.
Thank you.